Welcome back, everyone. This is a brief update on news from the oil market. WTI prices moved in a sideways motion in the latest days despite some data favoring a more bearish scenario. First, the API weekly reading released a surplus figure of plus 3.64 million barrels, lower than the previous figure, but still considerably high, while the EIA yesterday also indicated a plus 1.57 million barrels buildup. Both the readings did not have a significant reaction upon release, and impressively, WTI prices managed to hold value. Making a start with the US, where a reduction in active oil rigs has been observed lately. According to Baker Hughes, the energy services firm, total active rigs are now down to 668, a much smaller figure compared to the same week last year, which was at 887. Traditionally, the rig count has been used as a metric of upcoming demand. Yet, analysts consider the fact that oil firms may be looking to cut costs as we get closer to the closing of the year in order to obtain maximum returns for their investors and their own budgets. US crude oil production was very high in 2019, and according to EIA statistics, in August 2019, 12.3 million barrels per day were produced, a figure a lot higher than the 11.3 million barrels produced in August 2018. The current figure, which is even higher, around 12.9 million barrels, could lead us to the conclusion that the US already keeps a significant stack of the commodity to the side and may not need to increase oil rigs for the remaining of 2019. To make a sum up, many believe that oil production in the US will possibly continue to rise in 2020, even if a minor slowdown is also expected. Members of the OPEC group, like Iraq or Nigeria, may be a focus point when the meeting takes place in Vienna on the 5th of December. Even though these two countries have been loyal teammates as oil producers, they have not complied with cutting production and have kept output levels at rather steady volumes. Also, another interesting matter could be how the relationship between Russia and Saudi Arabia continues to unfold. Russia may not be satisfied with the current pricing of oil, or may even show its true colors on how they view the market in the future. Also, OPEC's general view on future expectations of the oil market could provide further interest upon the event. As a conclusion, oil traders have showed some reluctance in taking big action this week, even though they may have had some reasons to do so. The next target for traders could be any news feeds from the upcoming OPEC meeting that may be considered as unexpected by the market. However, other traders may be waiting on any significant developments on the US Sino front, as the matter could provide further reason to take action on oil trading. For more information and trading ideas, you can visit our webpage, follow us on Twitter, like us on Facebook, or subscribe to our YouTube channel. This is Angelos Zitis from IronFX wishing you solid trading.